Good evening and welcome to another episode, first one in a couple of weeks of Bond Squad After Hours. I'm your host, Tom Byrne, and soon you'll be able to see me. Here we go. And it's another exciting day here in the bond market and the capital markets in general. Excuse me, I have a little bit of a cold. Actually, I have quite a bad cold. It's starting to go away, but so if I seem under the weather or I start coughing, my apologies. Before we get down to today's events and last week's events, let's read the disclaimer so we may stay in compliance. Here we go. Investment advice is offered through Private Advisor Group, a registered investment advisor, and our registered investment advisor. Wealth Strategies and Management, LLC, my home firm, and PAG, Private Advisor Group, are separate entities, as is Bond Squad. The opinions voiced in this material are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. All performance reference is historical and is of no guarantee of future results. And that is that. Now our compliance people should be happy, God willing. Okay, so today's big news, and I should have mentioned on the bullet points, but I was under the weather yesterday. I was putting the bullet points together, and I left it out, but is the Fed, the minutes from the October Fed meeting. And there were no surprises for me. The majority of the members believed either that conditions were met for liftoff or would be by December. And I think conditions meant for liftoff off of zero were met last year. That's what I think the Fed should have gone to get off of zero. There was some concerns that maybe there was still some headwinds out there. There are headwinds, which is one of the reasons that we're growing at 2 to 2.5, not 2.5 to 3 or above, with zero rates and a huge Fed balance sheet. But what I want to do is get to something, because over the past couple of years, myself, my firm, and bond guys in general have gotten a bad rap for underestimating the path of interest rates, for underestimating inflation pressures, for underestimating economic growth. And the truth is that we have not underestimated anything. In fact, it's the Fed and many economists and mainly equity market participants that have overestimated. And the data bears us out. I'm not going to go screen share, just to pat myself on the back and say we've done it, but it has. And that brings us to the Fed minutes. I have a copy of the official Fed minutes right here. And it leads off with the discussion of the equilibrium real interest rates. And the Fed researchers, the staffers, have researched the subject, I would assume thoroughly, and they're of the opinion that the natural or neutral Fed funds policy rate is probably lower this time than it has been in the past. And they write, short run policy rate was estimated to have recovered only partially and to be close to zero currently, still well below levels that prevailed during the recent economic expansions when unemployment rate was close to estimates of its long-term normal level. In other words, what the Fed staffers are saying, that an appropriate rate right now, given all economic conditions, is, and I'm assuming they're including the huge Fed balance sheet, which is still QE. Remember, we haven't exited QE. We stopped adding to it except for reinvestments, which we still add, we reinvest the interest payments. But they're saying even with that, I assume that the appropriate Fed funds rate is still around zero. Now, around zero could mean a quarter to a half. It could mean 1/8 to 3/8. It could be 10 basis points, 20 basis points. But it probably doesn't mean that the Fed funds rate should be around 2. I think I'd like to see that 1, if only to take some of the dislocation out of the markets. I'm sorry, guys, and this is self-serving maybe, but I think high yield bonds, they deserve the comeuppance they've gotten. Emerging market bonds, if you overweight in them, believing the pie in the sky stories, you got what you deserve. Risk has to be managed as well as return, and the Fed can't keep, pulling your what out of the fire. So the Fed says here, with respect to longer term trends, the staff noted that multi-year averages of short-term real interest rates had been declining not only in the United States, but also in many large economies for the past quarter century, and stood near zero in most of those economies. I pointed this out ad nauseum over the past several years, that the trend for rates was lower. It wasn't cyclical, it's structural. You don't get 30-year cycles. Yes, some people might say, oh, from 1955 to 1980, we had a 25-year upward rate cycle. No, that was structural. You had baby boomers coming of age. You had Cold War spending, Vietnam War spending, Great Society spending. You had Europe rising from the ashes, Japan rising from the ashes, that was structural, guys. That wasn't cyclical. So what you have now is the structural echo, the rebound from that. That was an aberration due to a unique set of circumstances, and now we're back down low. And if you look at historical interest rates, I've beaten this to death, we're not that much lower than where we were prior to the 1960s, and if you take World War II out of it, well, maybe, and the baby boom that resulted and the rebuilding to foreign economies that resulted and so on and so forth, maybe rates would have stayed low from the 30s through the 40s, 50s, 60s, but things happened. World War II, baby boom, Cold War, Vietnam, Great Society, and some of it was necessary, was necessary to do. Some of it was a good thing. Servicemen came back and had families. That's a good thing, but doesn't last forever. So a number of participants said they expected the short-term Fed funds rate to rise as economic expansion continued, but probably only gradually. Moreover, it was noted that the longer-run downward trend in real rates suggested that the short-run Fed funds rate would likely remain below levels that were normal during previous business cycle expansions, and that the longer run normal level to which the nominal federal funds rate might be expected to converge in the absence of further shocks to the long run with maximum employment of 2% inflation would likely be lower than was the case in the previous decades. Again, even going forward, even later on in this expansion, which I think we're in the 8th inning anyway, the Fed funds rate's probably not going very high. Now, if you look at Fed funds futures, they're not predicting a 1% Fed funds rate till April or May. It's bouncing back and forth. I haven't checked it right this second. But of 17, by the way, not 16, of 17. One of my LinkedIn friends pointed out that Morgan Stanley has a formula, they have an index up on Bloomberg. And they're predicting 2.5, or roughly, so if we get 2 rate hikes, next year, that would bring us around 75 between now and the end of the year and the end of next year. That would bring us to 75 basis points, about, give or take. All right, that's probably all we're going to see in 2 years. Maybe we're at 1.5, 2, maybe. That's probably where you're going to see, barring anything changing demographically, economically, policy-wise, geopolitical, that's probably where you're going to see the Fed funds rate peter out. Now, is it interesting today? Interesting what happened today. One would expect, if you listen to CNBC ad nauseum, excuse me, I'm about to have a coughing fit if I don't drink, that a more hawkish tone to the Feds in the Fed minutes and a greater likelihood of Fed tightening would send interest rates rocketing. Now, at Bond Squad, we'd said the opposite. That when we saw the Fed getting ready to go, unless there was some expectation of inflation pressures really mounting, and growth running off the table, that we probably would see a curve flattening. And what we saw here was that we had ignore that. What we had was a situation where long-term rates, the 30-year, actually fell. Okay, the 30-year went from 309 to 304, and the 2-year went up about a basis point. It's about 88 basis points, I think, the last I looked. So what happened was we got a curve flattening. And what is that? Why would you get a curve flattening? Well, a curve flattening occurs because the Fed is saying, and they said in their minutes, that inflation probably doesn't run up to even 2% until the end of 2018, and only gradually thereafter, and then the Fed can come in and tighten, right? Meanwhile, the Fed's going to tighten ahead of that, which the Fed almost never does. So the Fed is telling us something here. The Fed is kind of telling us that low inflation, slower growth than what we've become accustomed to, And lower rates are, at least for now, the new normal. The Fed told us in the minutes. And remember, the Fed keeps erring on the high side. So what does this mean? Well, it means that if you're looking for to ride a floater and get higher and higher rates, well, let's put it this way: you buy a floater and you're getting 100 basis points over, or even 300 basis points over LIBOR, and LIBOR moves up with Fed funds. So maybe your coupon the next 2 years goes from 3 to 4.5. You could do better than that on a fixed rate at this point for the same type of credit risk that most floaters are. Okay. Probably do better than that in a 10-year taxable muni or as well. And if long rates aren't going to go very far, what does that mean? Well, it means that maybe we see the 10-year around 3%, maybe not during this cycle. So we probably have this lower rate for longer, and the equity markets liked it. Equity markets are already rallying. Got a little bit of a patriotic trade today because of what happened in Paris overnight. They got some of these people, use that term generously, overnight, and then we had some better earnings from Lowe's and Home Depot, and we had okay earnings from Walmart and Target, which we're going to talk about that in a little bit. And I mentioned in today's report. So we had equities up around 100 or so points, but then we jumped another 100 points after the Fed minutes. Whoa! Why did equities jump 100 basis points after we had the Fed? We had Fed minutes released. The Fed minutes that said that the Fed's probably going to lift off next month unless we see data that's really subpar. Well, because the Fed gave a very dovish path for tightening. It's not going to bring rates up much, and it's going to be slow when doing so. So that's that. And it's just what Bond Squad has been predicting. This is why we suggested back in mid-14, you know what? Don't be so afraid of a little duration risk. Long rates are probably not going up very much or very quickly because inflation is probably not. And the Fed tightening, even modestly, is technically, if not practically, disinflationary or anti-inflationary anyway. It helps hold inflation down or keeps it in check, at least theoretically, right? So that points to inflation not becoming a problem. It points to lower long-term rates. It does point also to a moderately or even just modestly flatter yield curve. So everybody's running around, the banks are going to lend, banks are going to lend now. Well, their net interest margin is probably not going to expand much. And they have another problem too, which it's a side discussion here because I didn't plan on it. They have a problem that they can't lend like they did before because of capital regulations and because of oversight on predatory lending. Banks are not going to expand lending in mortgages beyond what they're doing now. I don't think there's no reason for them to do so. You don't make enough money doing it to make running afoul of the regulators, worthwhile. So I'm not a big fan of that the banks are going to wrap up money. I do think the bank bonds are fine because I don't think there's ever larger capital raises and positions. A default of senior debt is less and less likely. So long story short, I prefer duration over risk, and we've seen that happen. In fact, the Fed mentions this here. The Fed mentions in the minutes that it sees cracks forming, and those are my words, not theirs. See if I can dig up the right words here. Oh, that they saw triple B risk premiums holding stable, that was one of my favorite areas of the credit spectrum, right? But they saw credit conditions and speculative grade bonds, junk, deteriorate. All right, this is because those were priced to, in my opinion, beyond perfection. They were priced for an unrealistic outcome, that the Fed would keep rates low. They cleaned their balance sheet. The balance sheets would stay clean of debt, and then this roaring economy, another V shape to the top, You had a V-shape, actually, look at a chart of GDP, but not back to the last two bubbles. Well, why should we go back there if they're bubbles, right? But don't let facts get in a good way of a good story. So now these junk credits are faced with waning investor demand for their debt, because you know what? A lot of that was energy-based or commodity-based or EM-based, and it was based on cheaper credit. And now that story's done. The Fed is not going to make their lives easier. The dollar will probably at least remain strong because of Fed policy. That's going to weigh heavily on these junk-rated corporate borrowers. And my opinion, just like we saw during the taper tantrum when munis got hit pretty hard, I believe because the way investors gain exposure to bonds, that in the junk market, that high yield could be sold indiscriminately. I saw this in munis during the taper tantrum. It didn't, whether you had distress among Puerto Rico and Detroit, and it spread to appropriations bonds and other troubled municipalities around the country of various degrees, and spread from them to state GO sold off, turnpike bonds sold off, water and sewer rev bonds sold off. It didn't matter because everything went down, and portfolio managers had to maintain ratios and had to sell what they could, not what necessarily they wanted. So babies clearly got thrown out with the bathwater, and that probably happens again in junk. So the sell-off probably spreads beyond commodities, even to domestically focused companies. Their borrowing costs are probably up, and the Fed noted that in their minutes. You can go up on the Federal Reserve website and look at it. I think it's like about, I want to say it's about 10 pages in, and they discussed that it was for all classes of high yield debt, spreads blew out. And I've been publishing this for a long time, including last week. So we see that change in the market sentiment. So again, some people think that high yield and emerging markets are cheap. I think that the prices are low. I don't know how cheap some of the stuff is yet. There are ways to look at it. You can look at for emerging market countries. Are they energy? Are they commodity exporters? Are they commodity users? Who are their trading partners? What does their GDP look like? The political system, fiscal policies. We can go on and on. You could pick out the babies in the bathwater. In the corporate bond world, balance sheet leverage stands out. Where are the customers? Do they depend on a slowing China or not? When do they have debt coming due? Which is something I'm going to transition to now, because in the bullet points for today's call or today's show, I want to discuss the risk asset. Well, it's part of this risk assets markets obsession with Fed Liftoff, which I kind of just did that. But there was something else, and I mentioned it in today's report. There's a problem on the retail side of this business to look at some of these junk-rated companies and say, all right, when's the next bond maturing? And they look, it's not maturing another 4 or 5 years, 3, 4, 5 years. It's fine. They don't have to worry about refinancing that now. By then, things might be better. So we're not going to worry about that. But there's a problem. As borrowing costs have risen because business models have become constrained. Well, let's go from the back. Business models become constrained. This is especially true in the commodity sector, right? So their revenues start to drop, or the revenues don't meet expectations outside of commodities. So they start having a problem not only servicing their current debt, but also generating enough money to pay the bills, to keep the lights on. So they tap lines of credit usually, and they come to market with bonds and they live off their debt to get them through rough patches. Problem is, and I posted this the other day, CCC yields have doubled since June of 14, almost. They went from 8.75% to 15.5%, almost doubled. Okay, we're not talking about 25 basis points. We're talking about 700 odd basis points for some of these companies. So they're like, all right, we don't have enough money to keep the lights on. Let's go tap the capital markets. We can't afford a 14, 15% interest rate. We got a problem. So when you're looking at investing in high yield, foreign or domestic, you have to look at what their balance sheet leverage is, their interest coverage is, their earnings have been. You can't just go, oh yeah, well, they get through with it. Just because something is down doesn't mean it's down because of an overreaction or inefficiency. That does happen, and I believe it has happened in areas of the market, but that is not the case with every credit. Let's move over to retail sales and the state of retailers in the modern economy. And we're running a little late on time, but we'll get through this. We've had some conflicting data. We had retail sales data that was kind of weak. That's the official measure. But personal consumption was robust. It was over 3%, and that's what, by the way, I noticed the media when they say that retail spending has been up over 3% the past year. They're looking at personal consumption, not retail sales, and the difference is personal consumption pulls in healthcare to a large degree. Retail sales really doesn't. So because of aging demographics and the Affordable Health Care Act, there's more money being spent on healthcare. And that, if you're using personal consumption as a measure of the health of the consumer, it kind of skews, it kind of glosses over things and paints a too rosy a picture, I think, because if you're spending more money on what's now a less elastic expense. In other words, you can't cut back on it as much as you might have in the past when you were younger, and when you didn't have legislation forcing you to buy healthcare or paying a penalty. Not saying it's good or bad; it's just fact. You have to do it. That's less money you have to spend on a discretional basis, right? You can't deny that. It happens, and with wage growth still relatively mild and coming from a lower base. Remember, wages are lower in real terms and in many cases nominal terms than they were during the last expansion. And this is especially true of people from my generation and the one ahead of me, older, who have lost their high five-figure, low six-figure jobs and now are working in lower to mid five-figure jobs. So they took a step back, less discretionary income. And that, I think, is showing up in some of the earnings data out there. We see, look, healthcare spending was strong. Rents, which takes up, if you look at CPI is a quarter of CPI is rent, and that's not a quarter of the expense in this country. It's an old metric. It's an old measure. People like CPI. They're comfortable with it. It doesn't give a good indicator. PCE does, and that's running at 1.25. Core. So this is backing out even the fall in energy prices, and we'll get to that too. So what we're seeing here is that consumers are doing an either or. So they're not buying sweaters necessarily, but they went to Home Depot and Lowe's and they bought home improvements, including appliances, and it looks like items to take care of deferred maintenance on their homes that they might have put off because they couldn't afford it, and maybe they're hoping to sell the home, move out, but they can't. They're still underwater or too flat on it. So that's where we're seeing it. And when they do buy discretionary items, they tend to hunt for bargains and buying it online. So we saw last week Macy's and Nordstrom's, pretty poor earnings. We see Target and Walmart today that were just okay. And then they beat the lowered benchmarks, lowered guidance. They went into right home about, and their online presence shrunk, right? Which, even though online sales in the last quarter increased by 15%. Excuse me, sorry, I'm fighting this cold. Getting a scratchy throat. So we're seeing this either or. So consumer discretionary, people say, go buy consumer discretionary. I think you have to be more targeted. I think you have to go ahead. Excuse me. I think you have to go ahead and cherry pick where they're spending. Online, experiences, home improvement items. I think that's where they're doing. And they're spending a lot on services and cars too. They don't have all this money to spend on everything. So apparel in a physical store is taking a back seat to the car, I guess, right? The problem with online sales, online purchases, is that there's less impulse buying. You walk through Macy's and you're greeted by people at each department. Sample this, try this. Have you looked at this? Signs everywhere. You go and touch and feel and say, yeah, you know what, I could afford that. You tend to do that less. Research has shown when you're shopping online. So that's holding back spending. I think it's a good thing overall because you have a healthier household budget, but things weren't priced that way. Things are priced for return to the mean, which the mean has changed. Before I die here, I want to touch on a few other things. I want to touch on sovereign yield curves a bit because where they are also influences what happens to U.S. interest rates. And as we see now, well, I can see, I'm not allowed to show it to you guys on the screen share anymore. We have the German 10-year right around 60 odd basis points. It's roughly 176 basis points, 177 basis points below the U.S. 10-year. That's the widest the gap has been since last March. I think there's a tether there. I don't think he can get to 200. So somebody's going to pull somebody the other way. The German yields are negative out to 70. Swiss yields are negative out to 10. You know, I don't really think that we can pull farther than that. And now we have the ECB and possibly the Bank of Japan coming in to do more QE, although the Bank of Japan says it's not. ECB says it very well could. And with the unfortunate attacks overseas, which I wanted to address in French, but I'm too sick to do that. ECB, more QE is on the table. So keep an eye on foreign rates, foreign yield curves as a guide of what U.S. Rates might do. Because remember, rates are really set by the markets, not by the Fed, except on the very short end of the curve. All right, I wanted to discuss since this is our last broadcast before Thanksgiving. I'm not going to do it on Thanksgiving Eve. Even I have better things to do than listen to Bond stuff on Thanksgiving Eve. But things to thankful. Well, I'm thankful for having my own gig, not having to do a crazy commute, and not being in a corporate structure. I like being able to say what I like to say. I'm thankful that as a firm, we did resist the urge to take out too much take on too much credit risk, and we took a little bit more duration risk this year. I'm thankful that most of the members of my firm did not buy into some of the sales pitches and gain exposure into some areas of natural resources and emerging markets. I'm thankful for my audience and my subscribers to make all this possible. Without you guys, I'd have nothing. I'd have nothing here. I'd be back on the bus to the city. So I thank you guys for your support. That's everyone out there. I'm thankful for the ability to, as you know, or the good fortune to see what came down the pike. I've been blessed by. I'm thankful for the mentors I had. Bill Malley, Harvey Goldsmith, Jim Krause, Mike Lane, Mickey Spillane. No, not the author, but a very, very good bond trader. Dario Rossi. These people really helped shape my career. Mike Catronio, Jeff Horn, more great Muni guys over the years, really helped shape who I am. Gave me my good bond market outlook, my Fed outlook, even my economic outlook, more so than school ever did. Because what I found as soon as I hit Wall Street was that theory tends to go out the window, in the real world. Almost like what I found out, later on in a military experience that the book, the game plan, the battle plan goes out the window once things start. You have to adapt, and these people, these mentors, gave me that experience, gave me the insight to do what I do. So if anyone's happy with the calls I've made this year, with my insight, my foresight, my analysis of interest rates, where they're going, and inflation, which now even the Fed is bearing out. They're moving to my camp. You can thank my mentors for that, because I would not be able to do that without them. And with that, I'd like to wish everybody a good night. Happy Thanksgiving. Please pray for the people in Paris. I was in Manhattan on September 11th, 01. I kind of know what it's like to be in that situation, although thankfully not really up close, down the street, but not really up close. But I know what it's like to be in that environment, and they'll get through this. There's good people over there, and hopefully the situation can be, as we shall say, resolved. And with that, have a great night. Goodbye.